Let's now look at example number 27. Now the institute is actually giving us examples of taxable temporary differences. When are we actually going to have taxable temporary differences? If you think of it, in case of an asset, we are going to have a taxable temporary difference when the carrying amount is actually greater than tax base. Why are we going to have a taxable temporary difference if carrying amount is greater than tax base? Carrying amount represents the future taxable income. Remember, the carrying amount represents the future taxable income. How much income are you going to generate from the asset that is taxable in future? The tax base represents the amount of deduction we are going to get in future. All right. This basically represents amount of deduction that we will get in future. If carrying amount is greater than tax base, it means that we have net future taxable profit. All right. If the carrying amount is greater than tax base, we have net future taxable profit. If it is a net future taxable profit, it's going to be a taxable temporary difference. All right. Because you have a net future taxable profit, it will be a taxable temporary difference. And on this, we are going to have a deferred tax liability. If I'm expecting profit in future, I will create a liability today itself. This is in case of asset. All right. In case of liability, if we are going to have a taxable temporary difference when the carrying amount is less than tax base, all right, we are going to have a taxable temporary difference. Remember, this chart is for taxable temporary difference. We're going to have a taxable temporary difference if carrying amount is less than tax base. Now, I told you that this is basically a very low chance. In case of a liability, generally you will have a deductible temporary difference only. All right. We'll see some certain cases at a later point in time where carrying amount can be less than tax base, but generally this is going to be a very low chance. All right. This will be a very low chance of actually happening where on a liability you will actually have taxable temporary differences. All right. Now let's look at example number 27. In fact, if you look at example 27, the institute has actually given all the cases only with respect to assets. All right. All example 1 to 5, point number 1 to 5 are all with respect to assets. There is not a single point on liability over here. All right. Because it is a rare case. All right. On a liability, you have very low probability of having a taxable temporary difference, which is also evidenced by the fact that all point number 1 to 5 are actually asset related points. All right. Now let's start with first point. Interest revenue, which is received in arrears. Interest revenue received in arrears basically means that I have an interest receivable on my balance sheet. All right. I have some interest income which is received in arrears, which means I've still not received. I will be receiving it at a future point in time. So basically, I have interest receivable on my balance sheet. All right. And if it is included in accounting profit on a time proportionate basis, what they're saying is where it is included in accounting profit on an accrual basis, but it is included in taxable profit on a cash basis. All right. So interest revenue or interest receivable, which is accounted for on an accrual basis, but is taxed on a cash basis, will result in taxable temporary difference. If you think of it, this example was exactly the first example that we saw. We saw example number 7, if you recall. It is the first example that we saw where we actually had a carrying amount of 100. I have interest receivable of 100 rupees. That future economic benefits that I'm going to receive from interest. Remember, for asset, we have to see whether the future economic benefits are actually going to be taxed or are they not going to be taxed. Over here, the future economic benefits are actually taxable, and therefore tax base will be equal to the amount that will be allowed as a deduction in future. Now, when the future interest is collected, the amount that's going to be allowed as a deduction is going to be equal to zero. All right. So the carrying amount will basically be equal to 100. The carrying amount will be equal to 100, but the tax base is going to be equal to zero because when the future economic benefits are received, the amount that will be allowed as a deduction is actually going to be equal to zero. And therefore, I am going to have a temporary difference of 100 rupees. Now, this 100 rupees represents my future taxable profit on which I will actually recognize a deferred tax liability. All right, this 100 rupees represents my future taxable profit on which I will recognize a deferred tax liability today itself. All right, so that was with regards to point number 1 within example 27. All right, now let's move on to point number 2. Revenue from sale of goods is included in accounting profit when goods are delivered, but it is included in taxable profit when the cash is collected. What they're basically saying is there are some debtors that are outstanding on my balance sheet. All right, I've sold goods in the current year, therefore I have got debtors of, let us say, 1 lakh rupees outstanding on my balance sheet. All right, so if I have debtors outstanding of 1 lakh rupees on my balance sheet, I am going to have carrying amount of 1 lakh rupees. Now, these debtors or these sales are actually not going to be taxed on an accrual basis, but they are going to be taxed when the cash is collected. The question is saying that they are going to be taxed when the cash is collected. So, the future economic benefits taxable? The answer is yes, because when I collect this 1 lakh rupees in future, I am actually going to have to pay tax on it. So, the future economic benefits are actually taxable. If the future economic benefit is taxable, then tax base is going to represent the amount that will be allowed as a deduction in future. The amount that will be allowed as a deduction in future is basically going to be considered as the tax base. Now, when I actually collect money, nothing is going to be allowed as a deduction. Just like in the case of interest receivable also, when I collect the interest receivable of 100, nothing will be allowed as a deduction. Over here also, when I actually collect money from debtors, nothing is going to be allowed as a deduction to me. So therefore, the tax base will be equal to 0 and the temporary difference will be equal to rupees 1 lakh, which is again a taxable temporary difference. This is again a taxable temporary difference on which I will have a deferred tax liability. All right, so that was with regards to point number 2. Now, what the question is also saying is, in this case, there is also a deductible temporary difference associated with any related inventory. What the question is saying is, if revenue is actually being taxed whenever the cash is collected, let us say if we are not taxing revenue on accrual basis, but if we are taxing revenue whenever the cash is actually collected, then the corresponding deduction, remember, whenever sales is taxed, there should be a corresponding deduction for cost of goods sold. Whenever sales is taxed, there should be a corresponding deduction of cost of goods sold. What the question is saying is, if let us say sales is going to be taxed on cash basis, then the deduction of cost of goods sold will also be on a cash basis itself. All right. If let us say I'm deferring my taxation on collection basis, if I'm deferring my taxation to whenever the cash is collected, then I'm also going to actually receive a deduction of inventory or receive a deduction with respect to cost of goods sold also in future itself. I won't be able to take the deduction of cost of goods sold in the current year and revenue will be taxed in the next year. That cannot happen. There can't be a situation where I'm taking a deduction of cost of goods sold in the current year and revenue is being taxed in the next year. Right? So hypothetically, let us say I have inventory worth 80,000. I have inventory which is worth 80,000. I have sold that for 1 lakh rupees. If I've sold that for 1 lakh rupees, what is going to happen is I am going to have this debtors on my balance sheet. I will be having debtors on my balance sheet and I won't have inventory on my balance sheet. I'm actually not going to have inventory on my balance sheet because I actually delivered the inventory. I'm actually going to de-recognize the inventory and recognize debtors of 1 lakh rupees. We saw that on debtors, we are going to actually have a deferred tax liability. What the question is saying is you're also going to have a deductible temporary difference on inventory. Why are we going to have that? Because let us say if carrying amount of inventory is 0, I am going to have a tax base of inventory of 80,000. Reason being, this inventory is going to be allowed as a deduction in future for tax purposes. All right, 80,000 will actually be allowed as a deduction in future for tax purposes. Therefore, I am going to have a temporary difference of minus 80,000, which basically represents the amount of future deduction that I'm going to get. It represents the amount that is going to be deductible in future for tax purposes, on which I am actually going to recognize a deferred tax asset. All right. So the question basically mentioned that in addition to having a deferred tax liability as a result of revenue that is going to be taxed when the cash is collected, I will also have a deferred tax asset on inventory. I'm going to have a deferred tax asset on inventory, is what the question is actually mentioning. So that is with regards to point number 2. All right. The third point is depreciation of an asset is accelerated for tax purposes. All right. What the question is saying is, let us say you have purchased a machinery for 100 rupees, let us say the cost of machine is equal to 100 rupees. The depreciation for year one, as per accounts, let us say the depreciation is actually equal to rupees 20, whereas the depreciation, let us say for tax purposes, is actually equal to rupees 25. All right, this is a case where tax depreciation is higher than accounting depreciation. This is referred to as accelerated depreciation. All right. This is accelerated depreciation under tax books. Why is it being called accelerated? Because the depreciation is higher under tax, right? The depreciation is higher under tax. Therefore, it's referred to as accelerated depreciation under tax books of accounts. As per tax laws, we have accelerated depreciation. Now, if you calculate the deferred tax in this case, we have a carrying amount of rupees 80. We have a carrying amount of rupees 80, which is 100 minus 20. All right. The tax base is going to be equal to, the tax base will be the amount that will be allowed as a deduction in future. The amount that will be allowed as a deduction in future is 75, because out of the 100, 25 is already allowed as a deduction for tax purposes. The amount that will be allowed as a deduction in future is 75. Therefore, my temporary difference is going to be equal to rupees 5, and this temporary difference represents the net taxable profit. All right, 80 rupees is my future taxable income. Against that 80 rupees, I will receive a deduction of 75. So my net taxable profit is rupees 5, on which I am going to have a deferred tax liability. All right, so this is a taxable temporary difference on which I will have a deferred tax liability. That is with regards to point number 3. The fourth point is development costs have been capitalized and will be amortized to the statement of profit and loss, but are already deducted in determining the taxable profit in the period in which they were incurred. All right, so let us take another example. Let us say I incurred a development cost of 50,000. I incurred, let's say, a development cost of rupees 50,000. What the question is saying is, for accounting purposes, I actually capitalize this. I capitalize this and I'm amortizing it. Let us say I'm amortizing it over 5 years. I'm amortizing it over 5 years, which means each year I will be taking 10,000 to the P&L account. All right. The question mentioned they've been capitalized and will be amortized in the statement of profit and loss. So each year I will be actually amortizing 10,000 rupees. At the end of year one, I'm actually going to have a carrying amount of rupees 40,000. 50,000 is the cost that I incurred. 10,000 will be amortized already for year one. Therefore, my carrying amount will be 40,000 for year one. Now, for tax purposes, the question mentioned that it is actually deducted in determining the taxable profit in the period in which they were incurred. All right, so this 50,000 is actually allowed as a deduction in year one itself. Whenever I incur these development costs for tax purposes, this is allowed as a deduction upon whenever I incur it, which means this is going to be entirely allowed as a deduction in year one itself. Now we hear tax base would represent the amount that is deductible in future. If the entire 50,000 has already been allowed as a deduction in year one, then the amount that will be allowed as a deduction in future will be actually zero. All right. 50,000 is the cost that I incurred in year one. Entire 50,000 has been allowed as a deduction for tax purposes. Therefore, in future, I'm going to be allowed no deduction, and hence my tax base will actually be equal to zero. Therefore, my temporary difference is now going to be equal to rupees 40,000, and this will be regarded as a taxable temporary difference. All right, because it represents the future taxable profit on which I will recognize a deferred tax liability. All right, so in all the examples, these are actually taxable temporary difference examples, and in all of them, we are actually going to recognize a deferred tax liability only. On taxable temporary difference, you'll always have a deferred tax liability only. Let's now move on to fifth point. Prepaid expenses have been deducted on a cash basis in determining the taxable profit of the current or the previous periods. What the question is saying is, let us say I am actually prepaying rent. All right, let us say I'm having a prepaid rent. Hypothetically, I have a prepaid rent of, let us say, rupees 10 lakhs. I paid rent for the next year, and therefore I have capitalized prepaid rent on my balance sheet of rupees 10 lakhs. Now, As per tax laws, let us say this rent is already allowed as a deduction on payment basis itself. This rent is allowed as a deduction on payment basis. Now, if we start plotting at the end of year one, I am going to have a carrying amount of, let us say, rupees 10 lakhs because I have a prepaid rent sitting on my balance sheet. The carrying amount of the asset will actually be equal to 10 lakh rupees. Tax base represents the amount that will be deductible in future for tax purposes. Now, when I paid 10 lakh rupees, I actually paid 10 lakh rupees. This was already allowed as a deduction. This already was actually allowed as a deduction upon payment itself. Although the rent pertains to the next year, the tax loss is actually providing a deduction on payment basis, and therefore this payment is already considered as a deduction for tax purposes. If out of the 10 lakhs I've already received 10 lakhs as a deduction, the amount that will be deductible in future is going to be equal to zero. Once I'm already given a deduction of 10 lakhs for tax calculation, I will again not be allowed a deduction in future. Therefore, my tax base is going to be equal to zero, and the tax temporary difference will be equal to 10 lakh rupees, which is going to be in the nature of taxable temporary difference, on which I again create a deferred tax liability. All right, so a prepaid rent, which is actually basically rent that I've paid in advance for the next year, and if it is actually already allowed as a deduction for tax purposes on payment basis, then nothing is going to be allowed as a deduction in future. Therefore, I will have a taxable temporary difference of 10 lakh rupees on which I create a deferred tax liability. All right, so with that, we are done with point number 5 as well, and we are done with example number 27.